Welcome back to Market Brief. In our last video, we talked about the perfect storm brewing in the global economy. We discussed the massive spike in oil prices, the closure of the Strait of Hormuz, and the inflationary shock that was threatening to derail the Federal Reserve's entire strategy for 2026. But over the last 48 hours, the narrative has shifted so violently that it has left Wall Street scrambling to reprice risk across every major asset class. We have just witnessed one of the most dramatic geopolitical reversals in modern history, followed immediately by the largest single-day crash in oil prices in nearly 6 years. Today is Wednesday, April 8, 2026. And to understand what just happened to your portfolio, we have to go back to the ultimatum that had the entire world holding its breath. For weeks, the United States had been attempting to broker a ceasefire in the Middle East. The goal was a 45-day pause in hostilities to de-escalate the conflict and reopen critical shipping lanes. Iran initially rejected that proposal, demanding a permanent end to the war. In response, President Donald Trump issued a terrifying public ultimatum. He set a hard deadline for Tuesday, April 7th, at 8 p.m. Washington time. If a deal was not reached by that exact moment, the consequences outlined by the White House were apocalyptic. Trump took to Truth Social and stated unequivocally, "A whole civilization will die tonight, never to be brought back again. I don't want that to happen, but it probably will." He threatened to blow up every bridge and power plant in Iran. The U.S. military intensified its operations, with Vice President J.D. Vance confirming strikes on military targets near Iran's Karg Island, a critical hub for the country's oil exports. The market spent Monday and Tuesday trying to price in the unthinkable. The S&P 500 dropped to a 7.5-month low, closing at 6,587. The Nasdaq 100 hit a 7.75-month low. The VIX, Wall Street's fear gauge, spiked to nearly 25. Investors were paralyzed, caught between the hope of a last-minute diplomatic breakthrough and the terror of a civilization-ending conflict that would send oil past $150 a barrel. And then, just hours before the Tuesday night deadline, the unthinkable happened in the opposite direction. The United States and Iran, with the inclusion of Israel, agreed to a 2-week ceasefire. The immediate terms of the agreement were clear. Trump suspended the planned bombing campaign against Iranian infrastructure. In exchange, Iran agreed to immediately reopen the Strait of Hormuz for safe passage. Furthermore, both sides agreed to begin formal negotiations in Islamabad starting this Friday. The relief rally that followed was instantaneous and violent. But the real story wasn't in the stock market. The real story was in the energy markets. When the news of the ceasefire broke, the geopolitical risk premium that had been baked into the price of crude oil evaporated in a matter of minutes. West Texas Intermediate, the U.S. benchmark for crude oil, opened Tuesday at $108.74 a barrel. By the time the dust settled after the ceasefire announcement, WTI had crashed to $93.68. That is a drop of $19.27, or 17.06%, in a single trading session. At its lowest point during the day, WTI was down a staggering 23%. Brent crude, the global benchmark, followed the exact same trajectory, plummeting 15.39% to close at $92.44 a barrel. To put this in perspective, this was the largest single-day percentage drop in oil prices in almost 6 years. The market violently unwound weeks of panic buying in a matter of hours. But before we declare victory and assume the crisis is over, we need to look at the fine print of this agreement. This is not a peace treaty. This is a 2-week pause. It is a temporary band-aid on a massive geopolitical wound. The Strait of Hormuz is open today, but the underlying tensions that led to its closure have not been resolved. The negotiations in Islamabad on Friday will be incredibly complex, and the probability of a permanent resolution remains low. Furthermore, President Trump made it clear that the economic war is far from over. While he suspended the military strikes, he immediately announced a new, punishing economic measure: a 50% tariff on any nation that supplies military weapons to Iran, effective immediately with 0 exemptions. So what does this mean for the U.S. stock market? On Wednesday morning, Dow Jones futures skyrocketed as investors breathed a collective sigh of relief. The S&P 500 erased its early week losses and began to climb back above the 6,600 level. But the reality is that the market is now operating on borrowed time. We have a 2-week window where the threat of a catastrophic oil shock has been removed from the table. But the structural issues facing the U.S. economy, the issues we were dealing with before the Middle East conflict escalated, are still very much alive. And as we will see in the next segment, the American consumer is beginning to crack under the pressure. While the world's attention has been completely consumed by the geopolitical crisis in the Middle East, a much quieter, but equally dangerous, crisis has been unfolding right here at home. The American consumer is finally breaking. For the last 2 years, the U.S. economy has defied gravity. Despite the Federal Reserve holding interest rates at their highest levels in decades, despite the persistent inflation, and despite the geopolitical shocks, the consumer has continued to spend. The latest data from the University of Michigan suggests that the resilience of the American consumer has finally reached its limit. In March 2026, the Consumer Sentiment Index plummeted to 53.3. That is a massive 5.8% drop from February and a 6.5% decline from the same time last year. To put that number in context, consumer sentiment is now at its lowest level since December 2025. The breakdown of the data is even more concerning. The current economic conditions index fell to 55.8, a 12.5% drop year over year. The index of consumer expectations, which measures how people feel about the future of the economy, dropped 8.7% in a single month to 51.7. And perhaps most alarmingly for the Federal Reserve, consumer inflation expectations for the year ahead spiked from 3.4% in February to 3.8% in March. That is the largest single-month increase in inflation expectations since April 2025. Jo-In Su, the director of the surveys of consumers at the University of Michigan, noted that the declines were broad-based across all age groups and political affiliations. She specifically pointed out that middle and high-income consumers, who hold significant wealth in the stock market, exhibited particularly large drops in sentiment. Why? Because they are being squeezed from two sides: the rising cost of gasoline at the pump and the extreme volatility in their investment portfolios caused by the conflict in Iran. This sudden collapse in consumer confidence has reignited fears of a U.S. recession. Goldman Sachs has now raised its probability of a U.S. recession in the next 12 months to 30%. Moody's Analytics is even more pessimistic, placing the odds of a recession starting in the next year at a staggering 49%. And yet, the stock market remains historically expensive. The S&P 500 Shiller-Cape ratio, a measure of valuation that smooths out earnings over 10 years, is currently hovering near 40. The Buffett indicator, which compares the total market capitalization of U.S. stocks to the country's GDP, is sitting at approximately 213%. These are levels of valuation that demand absolute perfection from the economy. They demand strong corporate earnings, falling inflation, and a cooperative Federal Reserve. Instead, we have a consumer base that is rapidly losing confidence, inflation expectations that are rising, and a geopolitical environment that is changing by the hour. And compounding all of this is the one-year anniversary of one of the most significant economic policy shifts in modern American history. April 2026 marks exactly 1 year since President Donald Trump announced his sweeping Liberation Day tariffs. When those tariffs were implemented in April 2025, the administration promised they would revitalize American manufacturing, punish foreign competitors, and eliminate the U.S. trade deficit. So, 1 year later, what is the reality? The effective tariff rate in the United States is now almost double what it was before the Liberation Day announcement. And the costs of those tariffs are being borne directly by the American consumer. According to the Yale Budget Lab, the Trump tariffs are currently costing the average U.S. household between $450 and $600 more per year. The U.S. Chamber of Commerce recently stated that a full year of higher tariffs has already raised prices and added cost pressures for many American businesses, particularly those that rely on imported materials. And what about the trade deficit? President Trump recently took to social media to celebrate, claiming that the trade deficit had fallen by 55%, calling it the largest drop in history. But the actual data tells a more complex story. In 2025, U.S. imports of goods totaled $3.4 trillion, which was actually a 4% increase from 2024. Exports totaled $2.2 trillion, a 6% increase. The total trade deficit in goods actually rose by about 2% to $1.24 trillion. The tariffs have undoubtedly reshaped global supply chains, but they have not eliminated the trade deficit, and they have undeniably contributed to the inflationary pressures that are currently crushing consumer sentiment. And just last week, on April 2nd, President Trump doubled down, issuing a proclamation that further strengthens Section 232 tariffs on imports of steel, aluminum, and copper. This is the economic reality we are facing as we head into the second quarter of 2026. A fragile consumer, historically high stock valuations, persistent inflation driven by tariffs and energy costs, and a geopolitical ceasefire that could expire in 2 weeks. And it is against this backdrop that the most important economic data of the month is about to be released. We have spent the first 2 parts of this video discussing the massive geopolitical shock of the Iran ceasefire and the underlying fragility of the American consumer. But the stock market is a forward-looking mechanism. It doesn't care about what happened yesterday. It only cares about what is going to happen tomorrow. And tomorrow, Thursday, April 10th, 2026, at 8:30 a.m. Eastern Time, the Bureau of Labor Statistics will release the most critical piece of economic data of the month, the March Consumer Price Index, or CPI. This report is going to dictate the direction of the stock market, the bond market, and the Federal Reserve's monetary policy for the rest of the year. To understand why this specific CPI report is so important, we have to look at the context of the last few months. In February, the CPI for all urban consumers increased by 0.3% on a seasonally adjusted basis, following a 0.2% increase in January. Over the 12 months ending in February, the all-items index increased by 2.4%. The core CPI, which strips out the volatile food and energy sectors, rose 0.2% in February and 2.5% over the last 12 months. These numbers were generally in line with expectations, and they allowed the Federal Reserve to maintain its narrative that inflation was slowly, but surely returning to its 2% target. But that narrative was shattered when U.S. and Israeli military actions against Iran sent energy prices skyrocketing. The cost of gasoline, a major component of the CPI, surged in March, and that surge is going to be reflected in tomorrow's report. The Federal Reserve Bank of Cleveland's nowcasting model, which is highly regarded on Wall Street, is projecting that the 12-month CPI inflation rate will jump from 2.4% in February to 3.16% in March. For April, the Cleveland Fed is projecting an even higher number, 3.56% year-over-year. Other forecasting models are projecting similar increases, with expectations for the headline CPI hovering around 3.2% year-over-year. If these projections are accurate, it means that inflation is not just sticky, it is re-accelerating. And the Federal Reserve knows this. In their most recent summary of economic projections, the Fed revised its inflation forecast for 2026 upward, from 2.4% to 2.7%. They also revised their core inflation forecast upward to 2.7%. This upward revision is a direct acknowledgement that the energy shock caused by the Middle East conflict is bleeding into the broader economy. And this brings us to the Federal Reserve's monetary policy. At their March meeting, the Federal Open Market Committee voted 11-1 to hold interest rates steady in a target range of 3.5 to 3.75%. The Fed's dot plot, which maps out the expectations of individual committee members, still indicates 1 rate cut this year. But the underlying data is shifting rapidly. 7 of the 19 participants now see 0 rate cuts in 2026. And the median estimate for the long-run neutral rate of interest has been revised upward to 3.125%. This means that the Federal Reserve is quietly preparing the market for a higher-for-longer scenario. J.P. Morgan Global Research recently stated that they expect the Fed to remain on hold for the entirety of 2026 due to persistent inflationary pressures in the U.S. economy. If tomorrow's CPI report comes in hot, as the models predict, it will cement this higher-for-longer narrative. It will crush any remaining hopes for a rate cut in the first half of the year, and it will put immense pressure on the stock market's historically high valuations. The Federal Reserve will release the minutes from their March FOMC meeting. These minutes will provide critical insights into the internal debates among policymakers regarding the inflation outlook and the potential impact of the geopolitical crisis. The Q1 2026 earnings season officially kicks off. As is tradition, the big banks will report first. JP Chase, Wells Fargo, and BlackRock are all scheduled to release their results before the opening bell. Goldman Sachs will follow on Monday. The expectations for this earnings season are incredibly high. Analysts are projecting a 12% year-over-year growth in earnings per share for the S&P 500. For the banks, the focus will be on their net interest income, the difference between what they earn on loans and what they pay out on deposits. With interest rates stabilizing in the 3.5 to 3.75% range, the traditional banking spread model is highly profitable. JP Chase is expected to report an EPS between $5.32 and $5.50. Wells Fargo is expected to report a massive 22.8% year-over-year increase in EPS. But as Goldman Sachs recently warned its clients, the headline numbers are not what matters. What matters is the forward guidance. Investors will be laser-focused on what these bank CEOs say about the health of the American consumer, the impact of rising energy prices, and the potential for a recession in the second half of the year. If the banks signal that consumer spending is slowing down, or that credit card defaults are rising above their historical averages, it could trigger a significant sell-off in the financial sector, dragging the broader market down with it. So, as we wrap up today's market brief, the week ahead is defined by a massive collision of macroeconomic data and corporate earnings. We have a 2-week geopolitical ceasefire that has temporarily removed the threat of $150 oil. But we have a fragile consumer, a re-accelerating inflation rate, a Federal Reserve that is trapped, and an earnings season that demands perfection. We will be watching the CPI report tomorrow morning, and we will break down the results of the big bank earnings in our next video on Monday. Until then, stay disciplined, ignore the noise, and focus on the data. Thank you for watching Market Brief. If you found this analysis valuable, please hit the like button and subscribe to the channel so you never miss an update. We will see you on Monday.